Hi everyone, my name is Piterpakulski. Today we have a final overview of manufacturing financial model, manufacturing business idea, and today I will be just playing with coefficients, inputs, showing you the capabilities of this model and what business starters, future business owners want to play with when all financial model is done, so they see the cash flow statement. What usually happens when everything is ready? Everything is ready in terms of formulas. So what is next? And today I would like to show you the process what people are usually playing with inside financial model, what inputs affect the financial efficiency, simple discounted payback period of this business idea. So I will be showing you today the whole model. I hope you will enjoy this video. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these videos, tutorials, how I've created this model from scratch, and I will give all the links in the description, how I created this model from scratch, all the tutorials in the description of this video as well, so you may watch it free video by video. So what we have, so we have the rule that all our inputs are colored with blue like this. Then if we move to the bottom, so we will be able to see the cash flow. And when the whole model is ready or inputs are in, usually the entrepreneurs want to see how much financing they need depending on the amount of loan they are planning to obtain and the amount of the money from their pockets, equity they need, or a business partner or an investor. So they are asking very simple questions. What will be the amount of financing? Then what will be the profit? This is the line, operating profit, the result from operating activity. What will be the result from this line? So this is the revenues minus direct costs, minus payroll, minus fixed costs, minus taxes, and it shows how the business breathes itself without external burden like loan payments. And they also want to see what is the actual profit if we take into consideration the loan payments as well. So we take this value minus this, and we get the final value of the profit. So usually these are this is the first items that business owners want to see. So usually they are asking questions about the revenues, why the revenues are so low, what we can do to increase the revenues, why expenses are too high. So they just starting they are pushing the plus button and see what is the structure of this or that expense. They just start diving into this or that expense. So basically people start getting acquainted, getting familiar with their business ideas. Then they look at the results. Then they look at the results of simple, discounted payback period, net present value, net value, internal rate of return, then financing needed. So they start analyzing their business ideas bullet by bullet. And first of all, so when they see the results, when they see financial efficiency, when they see the cash flow statement, when they see the structure of revenues, expenses, when they can see if they push pluses here, they can see all the details. They start moving to the very beginning of this model. So let's go up and see what people usually want to play with. So for example, we have, this is the simple and discounted payback period diagrams. And the first thing people usually want to play, for example, what will happen if we just produce only product A without product B, for example. So they want to switch, so we need to create in our financial model switchers like this to make us be able easily exclude all the revenues, all direct expenses connected, linked to the product B. So it is critical, and we can see that this does critical. It is critical for our business model. Or for example, what will happen with our business idea if the global production coefficient will be, for example, 50% of basic value. So for example, we assume that we're going to produce 300 units per hour of product A and 180 units per hour in product B. What will happen if we have only 150 units per hour for product A and 90 units of product B per hour manufacturing productivity? So I'm just using this coefficient, and we can go here to see how this affects the financial efficiency. So we can play with all these coefficients very fast, creating different scenarios and see how this or that parameter of input affects our business model. And from this moment, we start feeling our business idea for the first time. We see how this input affects, how that input affects. And usually during this process of playing with these coefficients, so this coefficient is playing specifically with product A, and this plays specifically with product B. And this coefficient plays with all these products in one time. So if we want to increase or decrease the whole production coefficient for both products. And we can play with individually with product A and product B. For example, let's say what will happen if product B production coefficient will be 50%. So we can go back. Just have to wait a little bit while the model is being recalculated. And this usually takes a long time for a business owner to play with all these coefficients. The next story that, for example, the entrepreneur wants to see what will happen if, so we have, for example, 2 manufacturing lines, and he says what will happen if I won't be using line number 2. So I have a capability of switching off the line number 2 in one click. So I'm just going back to sensitivity analysis and see how these affect our business model. And I can go back, for example, I can switch, for example, this line, but switch off this line, but switch on this line. So we can play with this data as well. So here you can see how usually during this stage of business idea, entrepreneurs play with data for a very long time. It takes them weeks to adjust all these coefficients. So for example, here for line 1 and line 2, we can allocate the time. For example, for for this is the basic scenario that we are looking at. And now we can, for example, say that in line 1 we will be using 50-50 time allocation. So 50% of time will be producing product A and 50% of time product B. But for example, for line 2 we'll be producing 10% of time product A and 90% product B. And now we can go to Sense tab, and let's just wait a little bit for model being recalculated, and we will see how this affects our business idea. And this is very interesting. Let's undo what we did. And now, for example, then we specify when we would like to start the operating activity, and it is very important and is very valuable that we can, for example, displace the project very easily. So now we are starting operating activity in September 2023. And for example, I would like to display the project to September 26, and we can just go to the diagram and see how this works. So we can easily displace all this story very quickly. Let's go back. Then we have a very important block of inputs. So here we can specify how fast we reach the target revenues. So this block is very important when we are looking at the cash flow statement. So for example, if we set up that we during the first month of operating activity we will be reaching only 5% of target revenues, then 10, 15, 20% of target revenues. So we can go to the cash flow statement and we can see that here we have the operating losses. And this means that we do need some additional financing to start our business idea. And if we start playing these inputs, so for example, if we reach faster or with a lower speed, we will be able to see the difference between amount of financing needed for the business. So usually people create a huge amount of scenarios playing with these inputs because they are able to see bad scenario amount of financing and good scenario amount of financing, and this is vital for future business owner to understand whether it is enough money in the pocket to start the business, or entrepreneur should wait and accumulate the equity for the start. So now let's move to shifts. So now we assume that we have two lines, and each line may have 3 shifts at maximum. And the first thing that future business owners want to look at is to see what will happen if they look at the base scenario payback period, and then they ask a very simple question: what if we work only a 1 shift? So we are just switching off the shifts for line 1, and we are switching off the shifts for line 2. So we have shift 1 working 1 shift a day and line 2 working 1 shift a day. Then we move to diagram and see what will happen with our business idea simple and discounted payback period diagram. So we see what happens. So this means that to have our discounted payback period inside the timeline, we need to adjust our pricing or introduce switch on a shift, or for example, if we just be using one line and one shift, we can for example do this scenario. So now we can see that how important this block of input is. So this block of inputs gives us a message that we'd better be working two shifts model. And usually when future business owner starts playing with shifts, they start understanding their business idea more clearly. They just start considering the equipment they're using. They start discussing the pricing strategy. So a lot of thoughts occur in their mind. So this is very important block. And the second story is when each shift occurs, when each shift starts. So they also play, for example, if we have this shift on, so when this shift starts operating, for example, this one starts from the first month of operating activity, this one, shift number 2, occurs after 12 months of operating activity, and then the third one happens when we are working 2 years after the start. And here, so the line 2 starts working on the 12 months of operating activity. This will be August 24. Then on the 18th month of operating activity, we will get the second shift. It will be February 25. So, and we can adjust all these parameters. So all these inputs will affect the financing, the payback period, and usually those people, the future business owners, always play with this block of input to understand what will be the payback period if we work 1 shift or 2 shifts or 3 shifts. Is it a huge gap between financial result between 1 shift and 3 shifts? So this is very interesting to look at. Then we specify the duration of 1 shift, how many work days we have inside each month, inside the typical year. And then we move to raw materials library. So here we can describe what raw materials participate in manufacturing of product A and product B. Here we specify what raw materials participate in its manufacturing. Here we specify the consumption of raw material for this product A in its matrix. And here we can easily increase or decrease the direct costs dealing with raw materials. So for example, we can see what will happen if our raw materials will rise on 50%. So if the prices on raw materials will rise on 50%, so we can go to the sensitivity analysis, and here we can see the simple and discounted payback period diagram. So here we can see what will happen. We can play globally, and we can, for example, play so we can, for example, look what will happen if specific raw materials will, for example, double the price, like this, for example. So here we can use local coefficients, and this is global coefficient, this is local coefficient, and we can go to the diagram and see what will happen if we will adjust only the local pricing for the raw materials. Let's put the previous values. So the system of coefficients is very useful if we need to create a huge amount of scenarios, and the amount of inputs is huge. So we can avoid playing with the inputs themselves, so we can just fill the business idea playing only with local and global coefficients. That is why we were modeling these blocks of coefficient when we at the previous videos that I was showing you. So then we are moving to plan. So then we are describing what we invest in, when we invest in, and how much we invest in before we start the operating activity. Then we are moving to the payroll. So we have a global payroll coefficient and local payroll coefficient for line 1 and line 2. So first of all, we can look and see what will happen if the payroll, for example, will grow 3 times. Let's just imagine that story. We can see here how the payroll affects our business model. So we can see that payroll affects less than raw materials. We can use local coefficients for just line number 2 or line number 1 or line number 2, or even more local coefficients for specific position. So we can play with coefficients the way we want. Then we can play with fixed payroll, office payroll. These coefficients are used for that. So here we have the names of positions, amount of people on each position, a salary of one person on each position, and then we can play with the salary globally and locally. Then we have some direct payroll, which is linked to the amount of units produced for product A and product B, and this we can also play with this direct payroll. So for example, what will happen if this type of payroll will rise 4 times, for example. So we can simply adjust the data and see the results without manual adjusting the inputs. So this is very important when we need to create lots and lots of scenarios, when we are touching our business idea for the first time, let's say so. And this is direct payroll linked to the amount of units produced. And then we are moving to the another type of another block of inputs. We are moving to pricing, and here we can specify different types of customers and allocate all the units produced between these types of customers. So we can, for example, and each type of customer will have its own pricing. So each customer will have its own pricing and its own payment algorithm. So for example, this type of customer which buys product A, the price for him will be this, and we will sell for him today, but we will get the revenues on the next month. And for example, this type of customer, we will the price for him will be bigger, but we will sell for him today, but we will get our revenue the month next to the next month. I don't know how to say. So to this month, the next month, and the second month after today will get the revenues. And this is very important. This payment calendar is very important, because if we displace the revenues to the right, we may displace we have expenses. That's why we have to finance all these expenses from our pocket or the loan and so on. So that's why it is very important to create this payment calendar, and this will help us to calculate the right amount of financing for the business idea. So here we can easily, so we can play with, for example, what will happen if the customers will pay us, for example, like this. So 10% of customers units will go to customer type 1, then customer, for example, type 2 will go 30%, and then 60% will go here. And we can go to the sensitivity analysis tab and see what will be the result. So now we can go back and we can here adjust how we adjust the percent of units for each type of customer, and we can play globally with pricing. So for example, what will happen to our project if the prices decrease on 30%? We will take only 70% of these values. So just let's wait a little bit. Or for example, what will happen if for example we take 50% of prices for product A and 70% for prices for product B, and then we can go back and see what will be the financial efficiency, what will be the simple discounted payback period. I'm just showing you the diagram, and here you can see the simple discounted payback period, the amount of financing needed, and so on. So this is the story about the pricing. So people usually play in this block of input a lot. They play with pricing, they play with payments algorithms, so the way how each type of customer pays us. Then we move to, for example, electricity costs, the price for electricity per kilowatt. Then they usually play with direct expenses linked to the raw materials. We have the same coefficients for this type of expense. Then we have direct costs linked to the amount of shifts. So we have global coefficient for this type of expense, direct cost expense, and local coefficients. So we've created the environment for a maximum detailed scenario play and sensitivity analysis play when everything will be ready, right, like now. So we can add the parameter to any input, to any coefficient, and press the sense button, and the macro will test the financial efficiency. What will happen if this expense rise or decrease? What will happen if this type of revenue will rise or decrease? Will it be okay for us? Will it be not? So this is a very interesting process for a business starter to fill their business idea. Then we are looking at packaging costs, for example, pallets. Then we specify the fixed costs. So here we specify what are the fixed costs in our business idea. Then we have a typical year where we describe the payments for these fixed costs. We have local and global coefficients. We can switch on and off different types of expenses. So all this is needed for scenario play, so it is vital. Then we specify the loan, if we do have a loan, the amount when we take it, the long term, interest rate, grace period for interest payments and principal payments, how we paid the interest rate. And then we are looking at, so we all this time we were partly looking at the cash flow statement. So when they adjust the data, the inputs, they look at the operating profit, they look at revenues, expenses, they look at profits, they look at the level of profitability, they look at the simple and discounted payback period diagram, they look at this table, what is the net present value, simple, discounted payback period. So these are the first numbers of people are focused on. Then when they see that for this scenario, this cash flow statement is okay to work with, and these financials look okay, then they usually want to test what will happen if some parameter will rise or decrease. So let me just show you how people sensitivity analysis. So if I remember, we don't have coefficient linked to the sensitivity analysis. That's okay. So what we can do, we can for example add parameter, for example, to the interest rate of a loan affect financial efficiency of our business ideas. For example, we have a loan with an interest rate, and then we can press equals, then multiply, go to cents, and add this coefficient to the model, sensitivity analysis to the model.
Then we press enter.
Now we have our coefficient added. Then we go back, and now we can press the sense button and see how the these parameter, if what will happen to our business idea if interest rate will rise or decrease. So I will put the step of changing interest rate with 10%. So 7% will be 100% value. Then we are adding 1.1 coefficient, 1.2, 1.3, 0.9, 0.2, 0.7 coefficient to this rate, and see what will happen. Let's press send button and see what will happen. So now we can see that what will happen to our financials, what will happen with our financials if the interest rate will rise or decrease. What we can do now, we can take this coefficient from, for example, interest rate, and add this coefficient, for example, to pricing. So here we have pricing coefficient. Let's add this coefficient here. So now this coefficient is added. Now we can go back. We can change the step of changing, the adjusting of the price. And now let's press the send button and see what will happen. So here we can see that if pricing will be 60% of basic scenario, we will go to minuses like here, and then we can set up here the values of target values for example, simple discounted payback period, and say if the simple and discounted payback period will be more than these values, we will get here a warning, or amount of we can't afford ourselves the financing more than this value. This will give us a red warning. And so what we can do next, we can, for example, go and detach this coefficient from pricing and add this coefficient to raw materials, for example. So as you can see, we can add, we can play with coefficients, add coefficients to any input we want. And for example, we can increase the step. Now let's press send button. So now you can see how many parameters affect the financial efficiency of manufacturing business idea. I just show you how entrepreneurs, future business owners usually playing with sensitivity analysis, playing with inputs, creating scenarios, where to look, how to interpret the financial efficiency of your business idea. So I hope you enjoy this video. You may like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. I will give you all the links how I created this model from scratch in the description of this video, and on the end screen I will give you the link to the playlist where I will be keeping all these tutorials, so you can watch tutorial by tutorial for free. So see you guys in next videos. Thank you and bye.